And thank you for joining us this morning for our CattleFax market update and outlook. As a quick reminder, all attendees are muted and video shut off. However, we'd love for you to engage with our presenter today by using the chat feature found at the bottom of your screen. You can find the chat feature by clicking the three dots on the bottom of your screen if you are on a mobile device, or selecting chat if you are joining from a computer. Before we begin, I'd like to introduce our expert on the call today. Mary Kurtzwell, analyst at CattleFax. Within her role, Mary watches trends within the industry, serves as a speaker at many conferences, providing insights and updates, and works with farmers and ranchers to understand their risk in the industry. As a reminder, this webinar is intended for informational purposes only and is not public or media consumption. Any opinions expressed by the presenters are of their own and do not necessarily reflect those of Farm Credit Mid-America. With that, thank you all for joining us today. This event will be recorded and shared following this webinar. Without further ado, Mary, I will turn the floor over to you.
Thanks, Marcus. Yeah, thanks for having me on today. I'm excited to be with you all. Like you said, if you have any questions, just put them in the chat and we'll hopefully leave time at the end to cover it. So to do that, let's go ahead and get started. Yeah, I'm Mary at CattleFax. So for our presentation today, we'll start kind of with a quick weather and grain update, and then we'll go into cattle supplies and expectations there, and then we'll get into the prices and those forecasts. But to start out, looking at the drought monitor here, you can see that it's in pretty tough shape if you look at the Southwest, but generally the East isn't so bad. The Northwest isn't as bad, but here in the central US, there's quite a bit of areas for concern with the drought. And if we think ahead, we're in a neutral pattern right now. If we think between La Nina, El Nino, and neutral, right now we're in the neutral pattern. But moving forward, the expectation is that we'll move back to La Nina, and that just generally means a drier weather pattern for the South and the Southern Plains, especially into the Northern Plains as well. So we're already seeing it. What's tough is that that's expected to continue as we look ahead, at least through the summer and probably through the end of the year. We'll either be in the neutral or the La Nina weather pattern. If we look on to corn prices and supply expectations, you can see here, so the bars here are the supplies, the stocks to use, is how we measure kind of corn supply. You can see that this crop year here, we thought that we had over 14% stocks to use, but as the reports have continued coming out, this has continued to decline. So now we're looking closer to 10% stocks to use. So that did help prices move higher. But now as we look into the new crop year, they've added acres to the planting expectations. And between that and then just a little bit softer exports or steady exports, that has the total stocks to use for this new crop year back closer to that 14%. So the price expectation with that is 440 for an average dollars per bushel. And if you look at that, there can be a pretty big range traded around that, but we shouldn't see those prices that we saw back in 20 and 21, given where our supply is at, because back whenever prices got to those levels, we had stocks to use below this 10% area for quite a bit of time. And that's what really allowed those prices to go higher like we saw those years. So we should have a generally strong enough supply situation to keep prices more moderate there on the corn side. Looking at hay, we've come down a lot on hay. We got into pretty tight stocks there in 2022 especially, and since then I've been able to build back up and prices have responded. I would say that we're probably at the lower end of the hay prices, just as you think that we're headed and going to continue this drier pattern. It's going to be tough to grow stocks a lot. And if you look at where the hay supply is, down in the Southern Plains especially, their stocks are down to start the year, and they're going to have a tough time growing a lot given what the weather patterns we're moving into is. So I do think there's going to be some pretty big regional differences as we look at the hay supply and then prices, but generally should be at the lower end relative to what we saw a couple of years ago. Mhm. So now we're going to get into supplies here for the cattle supplies. So I like to start out with this chart because it's kind of our sustainability chart. So if you look over the years, you can kind of see the ups and downs here as the cattle cycle. But a big key here is that every high continues to be lower. So that makes sense if we think about the aging producer, the declining land that we have in agriculture and that kind of thing. But at the same time, we've been able to hold beef production at these more elevated levels and actually produce the most beef here in this last cattle cycle peak. So with that, we've been able to see more weight put on the animals, of course, but also just more efficiency and then also the utilization of the dairy industry in the form of beef on dairy. So we've just gotten more efficient and still been able to provide this beef, even as we're not able to grow the cow herd as large as what it was in the past. But as we think about the cattle cycle, it tends to move in 10 to 12-year trends where your cattle prices are moving higher while the numbers are moving lower. And then it flips kind of, prices start moving lower, typically around the supply low, but sometimes it can happen a little bit ahead of that just because markets do anticipate the increase in supplies. But generally, it's a 10 to 12-year cycle is what we've seen over the past 50 or 60 years. Okay, but whenever we think about expanding, there's a lot of concern that we're not doing it. But what's it take to expand is it takes grass plus cash basically equals more calves. But we do have a lot of headwinds here still, even with that, because we've had the cash coming in, because we've seen prices move already. Some areas have the grass, some don't. But then also there's the headwinds of interest rates and high input costs. Labor, it's tough to find farm labor, as I'm sure you all know. And then the aging producer, and then just the volatility and economic uncertainty, and the sharp memory of the 2015 to 2016 decline. We hear that all the time, and it makes sense because, I mean, that's pretty fresh in our memories, is where we started losing a lot of money in cattle when it started going the other way. But I do think that there's reason to believe this cycle should be a little bit more resilient when we think of the cattle producer and cattle prices. And getting into that, we'll get into that here in a bit on why that is. Like I said, on the grass side, uh, we're not in the worst shape. You know, we don't have a lot of this severe, this exceptional or extreme drought, but we are getting a lot of cows in the drought section. So what we do here is we look at where the cow supply is, and then where the drought is, and see what percent of the beef cow herd is in the drought. And as we look at this, it is more than half of them are in drought. But it's not the severe drought. It's just that moving forward, we do expect that a lot of these areas will continue to worsen and just get darker as we look at this scale. So that is a concern. And if we look at the previous cattle cycle, here where this star is, you can see that we were at one of the lower ends of the spectrum as far as hardly any cattle were in drought. And so it was kind of a perfect storm of the grass was there. Cattle prices moved that way. And so we expanded so rapidly that then prices did move the other way pretty quickly because supplies got a lot larger. This time around, we're not able to expand as rapidly. And so we won't have those kinds of sudden supply increases. And so I think that does help prices stay a little bit more resilient. But as we look ahead, we do think that we saw the low here in the cow herd this last year, so 2025. It was down just another 150,000 from the previous year, just below that 28 million. Like I said, a good thing to look at here is from 2014 to 2015, there was just a small increase, but then you see almost a million head increase into 2016. So that was a pretty rapid expansion, and then followed by another about a million head increase into 17. So that was a pretty rapid expansion, We expect this to be a flatter increase because of those headwinds that I talked through earlier. So we do think that we should grow a little bit next year, mostly on the smaller culls that we've seen, and then a little bit more heifer retention. Should continue to grow into 27, but still not that big million head year over year increase. And even at the high, we don't think that we'll get back above this high that we saw in the last cycle because we are continuing to see lower highs there in the inventories and lower lows as well. So we do think that we'll start to rebuild, but I don't think it's going to be nearly as rapid or back to the levels that we saw in the previous cycle. If we look here, last year we did see a million head decline in this commercial cow slaughter. If we look on to this year, we're expected to be down another 350,000 head. Year to date, we're running about 130,000 head lower so far, and we're just a quarter in. But we did see a pretty small slaughter in the second half of last year. So those year over year declines will be kind of tougher as we do get into that period. But we do expect this to stay smaller this year and then also in the next few years. But even still, it's already come down a lot. So last year is already one of the smallest that we've seen in quite a while. But as we look, we haven't retained a lot of heifers. We were a little bit surprised to see this 2025 number down as well. So it was down just another about 50,000 head. If you look historically, it's the smallest we've been, and really in the past 2 or 3 years, looking back since 1990. We do expect this to start to grow, but again, if you look back at the previous cycle, that got pretty rapid. We don't expect to see it that rapid or to get that high as we think through this cycle. But one thing that this does is by not having them go as replacement heifers, it did add to our fed supply as we think last year slaughter did outperform expectation. Part of that was lack of heifer retention. And then another part of that was these Mexican feeder imports. So of course we're hearing about the tariff situation a lot, and then also with the screwworm limiting their imports to the US. So we would have been up probably closer to we would have probably been closer to this 1.5 million or 1.4 million to finish last year if they hadn't closed the borders at the end of November because of the screwworm. Since then, some of the ports have opened back up, and we are seeing some of those feeder imports coming from Mexico now. But as you look, we are expecting a smaller number now this year, and a lot of that is just restrictions with the ports. It just adds an extra layer and an extra step. And also, it took a while to get those open. So some of those cattle aren't going to come across now. And then the cattle that are able to come at this point, it's just a little bit slower rate than what we saw before. The other thing there is tariffs, of course, are a risk here, but at the same time, Mexico does have kind of limited options with these live cattle that they're sending to us because they only have so much capacity there. And they're also seeing quite a bit of drought and high corn costs because they don't produce as much. So with that, I do still think that we'll get quite a few coming from Mexico. And I don't think that buyers here will necessarily take on all of those tariffs because our prices are high enough that we're going to attract cattle anyways. And so I think that the Mexican seller might take a little bit of a discount to kind of offset some of that tariff cost. But either way, we are going to see fewer coming across this year. So that takes out of the fed supply as well. So retaining heifers and also getting a few less from Mexico this year is going to help that smaller steer and heifer slaughter. So as we look, this year we're expected to be down 700,000 head, and then followed by another 600,000 head the next year. So if we look from the top of the cycle here, we were at 26.5 million. And by the low in the cycles, which we expect in 2027, we're closer to 24 million. So 2.5 million head decline from the top of the cycle back down to where we expect the lowest to be in 2027. This year, like I said, slaughter did outperform expectations, part of that being lack of the heifer retention, and then more coming from Mexico. But like I said, this year, we can't expect that to continue and to offset the decline to the beef cow herd that we've seen. And if we look at weights, those have also outperformed expectations. And this 27-pound increase that we saw between 2023 to 2024 is the largest one that we've seen in history. And this year, we're on track to be higher yet again. Part of that is that this is cold carcass weight, so it's an average of all the cattle slaughtered. So we are seeing a larger percent of that being the steers this year, so that's going to help the weight increase. And then also fewer cows in that mix too. And then lately we have seen heifers get up to higher weights because they've started using that feed additive Experior in heifers as well now. And so that does help weights end higher, but just generally an increasing trend. And we do expect to see another pretty large year-over-year increase to the weights, which will help to offset some of that decline to the slaughter. So all in all, beef production for this year is looking to be down about 2% really. But like I said, last year, again, exceeded expectations, being about steady with the previous year between the increase to weights, which pretty much that offset the decline in cow slaughter, which we saw that was a 1 million head decline, but those increased to weights. And then with steer and heifer slaughter just above year-ago levels, that put production just above year-ago levels as well. But looking this year, we're expected to be down another 2% and then another 2% the following year. So by the end of the cycle, our beef production is going to continue to tighten, and that's supportive to prices for longer as well. But we will continue to import some more beef to offset some of that. So if we look, last year we were up 24% in imports. And if we look this year, we're expected to be up another several percent. Starting the year, it's been pretty strong already. And at the same time, exports have moved lower. But if we think about it, the exports are still an important market, as a lot of our hides and variety meats go there, and then also a lot of our higher quality beef that that other countries aren't really able to get anywhere else make up our exports as well. So our values coming in for exports is pretty strong, even as we do see a little bit less tonnage coming from a little bit smaller production. But imports is continuing to increase. And if we think about it, a lot of what we're importing is more on the lean trim side. So it's used as a supplement for our smaller non-fed beef production. As we look last year, here is the third bar from the right. This yellow is giant, but it's pretty much keeping our ground beef, is kind of what this is looking at, is our lean beef supply strong enough to meet demand. So what we're bringing in is a lot of that lean beef, and what we're exporting is a lot of times not only the variety meats and hides, but also that higher level choice and above beef to other countries. So if we think about it, the overall production being down about 2%, with more imports coming in and a few less exports going out, we're looking at a beef consumption of about 0.5 pound smaller for this year, and then a more severe decline in 2026, because we aren't going to be able to keep bringing in all the beef that we're not producing, because there's only so much beef globally, and prices would get pretty extreme as well. So at some point, we are starting to feel the tighter production in terms of per capita beef consumption. But to this point, we've kept it more elevated, and that's really been driven by not only the weights trends and the production trends, but also the prices that are bringing in that lean beef as well. So that's how we saw that increase in 2024, is that production was about steady, but then we brought in more imports and exported a little bit less. And that's really driven off of demand. So this higher consumption is really a demand story of our strength and demand. One more thing here for consumption is if we think back through the last cycle, we saw a pretty good drop in not only beef supply and production, but also pork, chicken, turkey. Everything was down in those years because of the tough production conditions that we were seeing. And so that allowed prices to get high enough, but it also allowed a pretty large correction whenever all these industries corrected at once. So whenever this jumped higher, we saw all prices correct quite a bit lower. This time we're going to keep our overall meat consumption more steady. Even though beef is coming out, we're getting a little bit more pork and chicken to supplement that. And so we should be able to keep the consumption more elevated, which kind of keeps prices a little bit more in line there as we think this cycle compared to the previous one. So now we're going to move into the economy and beef demand. If we look at the economic landscape here in 2025, we've got inflation down, so 2.5% to 3% is kind of what we're expecting. Interest rates are still elevated. They could move a little bit lower through this year, but we don't expect them to come down in a big way. About flat GDP is what we're kind of expecting. It could be lower, so we could move into a little bit of a recession, but what we are seeing is unemployment has remained low, and that's really helpful for just general food demand, because if we think about it, what typically is more resilient in recessionary periods is going to be that food demand, because people are still going to eat even if they're traveling a little bit less. But then we still got things like tariffs, budget deficits, government spending changing, Doge, a lot of people have been laid off of their jobs. So how much is all this going to impact demand as we think ahead? It's hard to answer these. There are a lot of unknowns, but things to watch, of course. But as we think about it, the retail beef demand, or beef demand in general, has been strengthening here. You can see that we kind of went through a pretty big correction to end in the 90s to the 2000s. And then since then, we've really been able to grow this beef demand. So you see this upward trend. Here last year, we measured the second best beef demand in the last 37 years. So this is taking into account overall supply situation, and then prices that we adjust for inflation. So prices did increase enough to show stronger demand last year, even with the supplies about steady with the previous year. So that does show strong beef demand as we think about it. And that's important because that's just more dollars in the system. So if you think about how high can cattle values go, well, you kind of got to start at the beef, how much money is coming in for the beef. And so if we think about the retail beef prices, we've seen those continue to grow. So through last year, we did get above $8 here. We're starting this year at $8.15 for January, and then up another 16 cents at $8.32 there in Feb. We expect that prices can get above this $8.50 here in the summer, and are just going to average pretty strong throughout the year. So that's just more money back in the system. If retail's bringing more, then the cutout can be higher, and then the Fed price can be higher, and then down the chain. And if we think about it, beef has really been the star at the retail counter. So since 1998, when we saw the low in beef demand, beef has been able to increase pretty consistently above inflation, so nearly 5% per year. At the same time, pork and poultry have not seen nearly the growth, and are really, pork's kind of kept pace with inflation, and poultry actually hasn't been able to do that even. But it kind of makes sense if you think they've increased their production quite a bit. And that would say that their demand might be steady, but since their production and supplies have increased, their prices really haven't. So pork has just barely kept pace with inflation, but beef has been quite a bit above that as we think back over the years. And why is that? Is that beef isn't really just a commodity product, and the demand kind of shows that. As you can see here, this is looking at the choice beef demand versus the select. We've seen that spread get wider and wider over time, and that's because people are willing to pay for the higher quality here and this higher eating experience. So you can see that really it's been driven by choice and above as we think about how beef has grown that demand. And we as producers have really responded to that in producing a lot more of what's being demanded of this prime and choice grade product. So over the years, just in the last 20 years, you can see that we were hovering around 50 to 55% of this choice plus prime. Here in the last 5 years or so, we've been 80, closer to 85% now of this prime plus choice grading beef. So we've really upped the quality, which is exactly what's being demanded, and we expect that trend to continue. And as you look, that also gets passed back to the cattle feeder there. As you see, this is looking at the grid prices for cattle grading over 80%. The premium is growing per head closer to this $80 a head here in the last couple of years as an average. And then if you look, if they're under 35% choice, you actually do see a discount for those. And that's gotten wider in the last few years, which makes sense as we look at the select and the choice cutout and demand there. One last thing with demand is that looking at our capacity. So this is slaughter capacity here. Here in the last few years or through COVID and really past that last cattle cycle, we did close quite a few plants there. Tyson, the National, Cargill, we closed several. And so then at that point, our fed slaughter was larger than what our capacity was. So they were working Saturdays, doing extra shifts to get through the cattle. But at that point, the demand for the fed animal wasn't as high as the supply was because there just wasn't capacity for them all. Now we are moving back to where capacity exceeds that supply. So we do see packers bidding more for the cattle with that. But definitely something of concern here is that we could force another plant to close with that. So that's definitely something we're watching. And it could happen as early as this year, but we don't at this point, of course, know what that would be, where that would be, or any of that. But definitely something to consider as we think about what can make cattle turn the other way a little bit early. If we were to shut down a plant or two, that would really do it, or that would at least tighten this equation a little bit. But actually what we see this year is we've got another plant coming online. So capacity is actually going to increase some this year, at least up to this point with what we know today. Okay, so now to get into the forecast. Just kind of a big picture, what all do we look at with price forecasting? So we're looking at inventory weights, kind of all the supply factors here. And then also we're looking at the overall cattle cycle, what are we doing and what do we see ahead? And then competing products and what their prices are doing, kind of the global picture, imports, exports, and then the demand, the leverage, weather. So there's a lot that goes into this. But anyways, looking overall at the Fed steer price, we have been pretty explosive here lately. But typically what we see is we see 4 to 5 years on the upward part of the cycle, and then 5 to 6 years on the correction where it starts moving lower. Like I said, this last one is pretty extreme where it did move lower pretty sharply. If you look at previous cycles, that's a lot less sharp because we see a lot slower increase to supplies. So we expect more of a flat, kind of a slower decline this cycle, and that's going to be because it takes a little bit longer to get the supplies larger again. With where we are today, prices actually got up to $2.12 last week, so this isn't quite updated, but it was a $7 increase week over week. So we wouldn't have expected prices to be quite so firm to start the year, but demand has been good, and supplies have been tight. So that's really been supportive to prices here lately. Um, and so our average for this year is going to be 200 plus, but uh, our our range to the upside is kept growing because prices have outperformed our expectations here through the first quarter, but generally should stay elevated. We do still expect to see a break, probably more in late summer to early fall, um, before we do see this seasonal rally again. But you can see last year didn't really follow that seasonal pattern, as we did see more of a June high. That was kind of the previous year as well. We have seen a little bit of a shift in seasonality where the high is coming a little bit later. A lot of that being is that that's when we see the best beef demand. And at the same time, we're feeding these cattle longer. So now, when our supplies were the tightest was in April, now that's moved back to more June because we're feeding them for longer. And so that just got pushed back a little bit. If we look at the feeder cattle here, we would say that the average this year is 276, but again, this has kind of exceeded our expectations here lately. Range for this year was 270 to 290, but we've held pretty firm in the mid 70s. And if we look at the futures today, they do kind of show more of the seasonal pattern with an increase in the second half. So they've had a lot more upside than early than what we may have expected, but now the futures are showing that. One important thing to note here, though, is that this makes risk management all the more important because we've seen, especially if we think back to that last cycle, how quickly these values can go the other way as well. So we just need to be vigilant with that. While we do expect prices to stay strong, there is a lot of risk and headwinds going forward that some of them we can predict and some we can't. So it is important to manage the risk, but we generally expect prices here to stay supportive and elevated. And if we think the seasonal pattern would say prices move higher into the fall, we do expect that because that's the seasonal pattern of when cattle are available. But here it's just been tough to fill feed yards with the tightening supplies. And so that's just really supported these prices in the first part of the year. Looking at calves, those prices have remained elevated as well. But as we think, we do have this pattern, the seasonal pattern, where prices do tend to move lower into the fall. As we do see our fall calf run, you do see increased supply, so less of the decline. But if we think the last couple years, that the decline has been less pronounced, especially 2023, but even 2024, it wasn't as large. So we expect that again because we are just seeing tighter supplies. But this 340 average, it might be a little bit low with where we've seen values today. But if we think about it, the pattern does say that prices move lower in the second half. Like I said, I don't expect it to be a large decline, but that the seasonal is in place for a reason because we do typically see more come on the market in that time. But the range around that is at 320, so we see pretty good support there, and maybe even at 330 now at this point, we've seen pretty good support. And then upside potential up to 370 or maybe even 380. And that's going to be partially driven off of what the futures do for the feeder cattle and fed. So the higher that those back end contracts go in the fed market, that gives more upward potential to the feeder cattle, which then gives more upward potential for the calves. If we think about marketing calves, so here this is looking at the last 10 or 15 years here of the video sales versus the fall cash price for these feeders. You can see that in the last 15 years or so, it does typically pay a little bit more doing the video sales versus the cash market, but on good years, those increases do tend to be smaller. And like 13 and 14, we actually saw a little bit of a discount there for the video sales. just because those auctions did get pretty explosive in that time. So we do expect, well, last year it did pay a little bit to do the video sale. This year we would still expect it because with the video sale, they are just able to um, mark all the different attributes for the cattle. So I think it's here in this next slide. Okay, yeah. So we've got pretty good data on the video sales where we're able to look at what tends to bring more at the auction. And as we look at this, the most important attributes is kind of the big thing to look at. It's no horns, weaned. Weaned calves tend to bring about almost $10 more a hundredweight in 2024 than non-weaned. And so that just kind of indicates where we see the most added value by attributes in the video auction data. We're kind of able to look at that. Horns are obviously a discount here. And then some other big things are if they're doing the VAC 45 and they're weaned, that's where we tend to see the biggest price increases or premiums paid. And then just genetics, you do tend to see the highest premiums there for the English bred cattle and then the continental influenced, where we see maybe a discount or more average is like ear cattle, Brangus, and those. But at this time in the cycle, we are going to see everything worth quite a bit. But this gets more and more important as we do get to the other side and we see increases in supplies. And then it does start to matter more and more the genetics and the attributes that you have on your cattle. If we look at bread prices, those have gotten pretty explosive here. So you can see the pattern, the seasonal pattern is to move higher now and then typically drops whenever we do start to see more coming available and then moves higher again into the end of the year. So to finish last year, we were at about $3,000 per head. And if we look in the last 2 months, we're more at 33, 34, even up to 3,600 this last month for the bred heifer price. So those prices have moved higher in a big way here. And I do think that's going to be one part of the equation that does help heifer retention and those supplies grow a little bit, is that there's some economic incentive now that the replacement heifer prices are getting so high. If we think about this year, we do see upward potential up to 4,000 for a bred heifer. Just thinking we've gotten pretty explosive already, but that could move quite a bit higher even still. And it's probably going to be pretty well supported above this $3,300 per head. And that's kind of what we saw last cycle, is that you saw the bred cow get quite a bit above what this fed steer value was. And so that really does grow the incentive to start keeping heifers back. We are getting above that now. And so I do expect that we will start to see some retention, but these do tend to correlate pretty closely, as you can see, 0.96. And so it makes sense that we are seeing this grow as it is, and that's going to help us to grow the herd a little bit. Another metric that we look at here is thinking about the number of calves it takes to pay for a female. And so as we look here, the low was obviously 2023 here at 2.1. That's where female prices hadn't really moved, and the calves and the fed steers had. As we look ahead, female prices have moved now, so now it does take more calves to pay for that female. But if we look, that's a pretty cyclical pattern, so it does make sense. But as we look on ahead, it is getting to the point where expanding now is going to be pretty expensive, and it will take several calves to pay for that heifer. But with the expectation that prices are going to stay more supported for the years to come in the calves and the feeder cattle, it still would make some sense to expand there if you've got the ability to, given what we expect with prices, because it's not getting nearly to where it did in 2015, where it got to you needed 9 calves to pay for that female, with where their prices were versus where calf prices were. Looking at this utility cow price, you can see that's extremely elevated. If I also had the 90s trim, this is the lean beef cutout on here, or lean beef um, on prices on here, it would follow a really similar pattern where you do see prices the highest in spring and summer. That's when ground beef hamburger demand is best. Um, and so this utility cow price pretty closely follows that. We do tend to cull more cattle in the fall, so there's where you see the prices soften some, but as you can see this year, that softness was pretty limited. Prices still stayed more elevated. Um, our expectation this year is that we'll average closer to that 140 a hundredweight, and a range around that with pretty good support, that 125, and probably some resistance at that 155, but um, with the average being right around this 135 to 140 for these utility cow prices. All in all, looking at this cattle price forecast, so this is going out to 2027. You can see that we've got our highs here in 2026 as our expectation. And as you can see, unlike the last cycle where we saw that large decline, we don't expect to see that this year or this cycle. So we are still moving higher, but as you look, we've gotten the impulsive moves kind of out of the way with these large year-over-year increases that we've already seen. We do still expect prices higher this year and again next year with tightening supplies, but the year-over-year gains do get smaller here looking ahead because we've seen the big jumps already. But even when they do start to turn the other way, we expect that to be a much smaller decline than what we saw last cycle. Maybe more similar to the previous cycles where it was a slower decline. Looking at the profitability, you can see that when we saw that poor demand, so in the 80s and 90s, we were pretty much a break-even business at that point all the way through. Then we got to better demand, more dollars came into the system. We saw more like $170 per head, but now if we look, there's just a lot bigger pie here. So a lot more money is coming into the system and profitability is better. Now where that goes, you can see a lot of it's returned here to the cow-calf producer in the last couple years, and we expect that to continue. So the cow-calf and the stocker are going to continue to get a larger piece of that pie, as we are just going to see a tightening outside supply there. Okay, that's all I've got. So I ran through that pretty quick, but wanted to leave at least a couple minutes for questions.
Yeah, Mary, no, thank you so much for that expertise and efforts that you always provide, especially regarding these projections and forecasts. We did have a few questions come into the chat. First question we got is, can we expect increase in imports of boxed beef to lower feeder calf prices?
Uh, so we saw with the imports that a lot of what we're importing is going to continue to be that lean beef, so non-fed slaughter or just the non-fed slaughter. So I think it's going to be tough to really increase the boxed beef at the U.S. quality, the fed quality that's choice or higher. So I don't really see that coming. No.
Perfect, thanks. Another question we got is, how should cow calf and backgrounding operations think about break evens right now?
Yeah, that's a good question. One good way is to look at that um, price per, or how many calves it takes to pay for your cattle. So if you're looking to buy uh, more cows, you got to look at how much you can expect to sell your calves for in the coming years, and how many calves it'll take to pay for that cow that you're buying today.
Thank you for that. Let's see, another question. Are you seeing any regional shifts in where cattle are being raised due to drought, input cost, or labor?
Yeah, so the Southern Plains over the last few years have seen the deepest decline in this cattle cycle, and that's just they've been hit the hardest with drought. Where we see a few more cattle getting but is in the Northern Plains, but it's pretty tough everywhere to get a lot more cattle. Southeast has also moved lower, I think more with urban sprawl and aging producers less ag land in that case. But yeah, the Southeast has been hit pretty hard by drought, which is
Mhm.
making the numbers struggle.
Gotcha. We might slide in one more question. How much fallout do you expect we'll see with Packers as profits have moved to a lower negative?
It's a good question. Yeah, the Packers are really competing for cattle right now, which has allowed those high fed prices we've seen. We do expect that probably a plant will close by the end of the year, and it could even be two. Like I said, one plant is opening here in the next couple months. So, yeah, we do expect that probably at least one will go out of business and potentially two.
Gotcha. Gotcha. Well, we have preached. We have approached the end of our time, and I do want to be respectful of that. So, Mary, again, thank you so much for your time this morning and joining us. Thanks to everyone who did join the call this morning. Mary's presentation has been recorded, and it will be shared shortly. I also want to thank our co-host who's making these things happen behind the scenes. So, again, look forward to seeing everyone next time, and then that recording will be shared here shortly. So, everyone, have a great rest of the day.
Yeah, thank you. And Marcus, you can feel free to send me over any email questions that people have too. I'm sorry we didn't
Perfect.
leave probably enough time for all the questions we got, but I'm happy to answer through email too.
Absolutely. I will send that over. I want to say we had one or two more that we didn't get to. So
Okay.
yeah, so amazing job again. It seems like everyone was very interested and had some questions for you. So I'll make sure to send those that your way.